This is the Honorable Caroline D. Pham. She is the acting chairman of the Commodity Futures Trading Commission, right? Known as the CFTC. Guys, I don't want to talk too much. We need to pay attention to how close we are to adoption, okay? It is real. At the highest level, they are sorting out cryptocurrency. They are sorting out custody. Please pay attention. Listen to the whole video.
Same under the new administration. What's the same is that there is no tolerance at all for fraud or for scams, right? It doesn't matter what kind of fraud you're trying to commit, whether it's crypto fraud, whether it's some other kind of Ponzi scheme, it's just not allowed. And in fact, you've seen across the DOJ, the CFTC, and the SEC that we have all redoubled our efforts to pursue fraud in crypto and across the spectrum. But what's different? What's different is that in this administration, we have optimism. We have optimism about the promise of a new technology. We have optimism about its ability to contribute to the growth of the American economy and to prosperity for all Americans. And we have optimism about the ability of our government and our regulators to deliver on that promise. And so I'm very proud to be a part of that. And how are we accomplishing this? So I think it's really important to take a step back and really define what we mean when we're talking about digital assets, and particularly what it means from the financial market regulator perspective. So to me, when we talk about digital assets, it's really two distinct categories. The first is that digital assets is a new format, so tokenization, of traditional financial instruments. The second is that unbacked crypto assets is a new asset class. And so how we approach each of those things from a regulatory perspective is going to be different. When it comes to tokenization, we should have a tech neutral approach, just the same way that we went from paper stock certificates to electronic records to now records on a blockchain. It shouldn't make a difference. Our securities markets will be deep, they will be liquid, they will be the greatest in the world, and they will contribute to the engine of growth in America and for entrepreneurs all over the world to come here for our amazing universities and our cheap and plentiful funding in both private and public markets. What is the other thing that's really important to keep in mind? What's important to keep in mind is that what are the use cases, right, that digital assets can bring to financial markets? And I see them as three key benefits, right? So number one is the ability to enable greater liquidity formation. And actually DeFi has a tremendous ability to aid in that liquidity aggregation and formation. Number two, and I've been saying for 3 years now, and I used to work at a big bank, so I've been very focused on this. Number two is that the killer app for blockchain technology in traditional financial markets is more efficient collateral management. The CFTC oversees the $700 trillion notional derivatives markets. There are untold amounts of margin and collateral being exchanged every single day. And with blockchain technology, that can become tremendously more efficient. And by being more efficient, it allows financial institutions to redeploy those assets in more productive ways. It can allow financial institutions to provide more credit to households and businesses. It can allow financial institutions to put those assets to work in many other ways. And then finally, number three is that the blockchain technology can reduce risks. Clearly, it reduces operational risk, but it can also reduce other financial and non-financial risks. So as an example, there are reports that have come out that have said that tokenization can save billions of dollars a year in both OpEx and CapEx. When you take that and extrapolate it out across the banking industry or other financial institutions, it's a tremendous savings. Now, what has the CFTC been doing to address these different areas? When it comes to tokenization, thank you, Nicole, for serving on the CFTC's Global Markets Advisory Committee's Digital Asset Markets Subcommittee. Last year, that subcommittee came out with not only a digital asset taxonomy to help bridge the gap between the lack of regulatory clarity in the United States and the standards that have been implemented across international standard setters as well as other jurisdictions, but we also importantly came out with a recommendation for tokenized non-cash collateral. That could be tokenized treasury ETFs. And so I'm very pleased to say, I'm announcing this is big news, the CFTC is going to be soon participating as an observer in industry tokenization pilots so that we can better understand the use cases and the benefits of the technology and engage in capacity building so we can be ready for a new or more expanded role. When it comes to crypto assets as an asset class, obviously having predictable rules helps the maturation of the asset class. So there's the President's executive order on digital asset markets. There's the President's working group that the CFTC is proud to be a member of, and we're contributing towards that 180-day report. We've been providing technical assistance to Congress, and just today they released the discussion draft of the market structure legislation. And we rescinded 2 advisories that were not appropriate anymore given the development of the asset class, that were specifically targeted at heightened standards for crypto derivatives. And then we have completely ended regulation by enforcement consistent with the DOJ memo. So it's been a tremendous amount of work that we've accomplished in the first 100 days. And so I just want to leave you with some lessons learned as we think about the approach to regulatory clarity in the United States for crypto assets. I think when you consider what was the last most transformative piece of market structure legislation, it was the Dodd-Frank Act. It was how the Dodd-Frank Act completely changed the swaps markets, which, by the way, the CFTC also regulates. And so I implemented Dodd-Frank. I not only worked on the rules when I was staff at the CFTC, I then went to Citi and was the global head of swap dealer and Volcker compliance. And I ran $1 billion compliance program, and the industry spent hundreds of billions of dollars in registration and compliance costs, and it took the CFTC 4 to 5 years to write the rules to implement the Dodd-Frank Act. But what did Dodd-Frank really result in? I think there's 2 things that everybody needs to keep in mind about getting the legislation right, and I really commend the efforts of Congress, and I've been pleased to help with this. We have to make sure that the compliance costs don't crush the innovation and crush entrepreneurs, because one of the unfortunate results of the Dodd-Frank Act, while it made many aspects of the market structure better, particularly central clearing was a great innovation, but it ended up with regulatory moat, so that the barrier to entry was almost just completely prohibitive unless you were the biggest of banks. And number 2, it resulted in market fragmentation. And because digital assets is inherently a global and borderless market, I think we must be careful to avoid the market fragmentation that could be an unfortunate result if we don't get it right with not having the overbearing compliance costs. Thank you.
And what we are